dramatic things are happening with Tesla stock in October. That is my prediction. And it's based on a multitude of factors. But in the middle of that set of factors that I'm focusing on is the affordable model launch. And as you probably know from my previous videos, yesterday and on Monday, I was fleshing out my theory that the affordable model will be launched in October, which is now. And the affordable model is a very important catalyst, even though a lot of Tesla bulls and retail bulls are not emphasizing it too much because it's boring, it's the old EV and auto industry. But the institutional investors love that thing because it increases Tesla's total TAM of the current business by 3 to 8x, depending where it comes in. Now, let that sink in. 300 to 800% more revenue and more market potential for Tesla's core business that is responsible for nearly all revenue right now outside energy. So if you didn't watch the videos, please go back to the channel, look at the last 2 videos and catch up on the core thesis so you understand on a fundamental level why I'm so convinced, and I'm not the only one, that the affordable model will launch in October, massively expand Tesla's TAM by 300 to 800%, and that this is actually a surprise where most people do not factor that in right now, which gives us alpha. In this video, as promised, just in time, because Tesla stock already shows a lot of bullish behavior today, we are going to go into what I am doing in terms of putting on the trade. That is one of the safest trades, in my opinion, this year. And we will discuss what technique you're using. Do you use stocks and margin? Do you use call options, short puts, and so on and so forth? That is the topic of this video. If you missed the fundamentals, go back to the other videos. So, first of all, when we do any kind of leverage trade, and by the way, this is not investment advice. Don't just do what I'm doing. I'm just sharing what I'm doing. This is definitely not advice. It's actually very dangerous. I just want you to understand what I'm doing. When you do these trades, it's very important to look at the surrounding risk factors. And I always start big picture, what risk are we looking at? As you know, I predicted that I see a 50% chance of a seasonal correction in September and October. Now, the majority of that risk was concentrated in the Fed meeting mid of September, and the risk did not crystallize. My concern was that Jerome Powell is actually looking at the unemployment numbers that are becoming exponentially worse, but the government is hiding it a little bit. So I was unclear how much leaks out and how bearish Powell is. He was not too bearish. The market just shrugged it off and went on. So that eliminated most of the seasonal risk. And the remaining risk, in my opinion, not all remaining risk, but the largest share of the remaining seasonal correction risk of the entire market, of S&P and NASDAQ, is now concentrated in the next Fed meeting, which is October 29th, which means green light for us. We do not see any kind of catalyst for a seasonal correction before Tesla earnings on October 22nd, which is the main concentration of our trade. So green light on the risk front on the market. Green light doesn't mean it cannot happen. We are still in a very dangerous season. So we have to watch the market, but this is definitely one of the better 2 weeks we are looking at, 2 to 3 weeks. Hey, creating these videos is a lot of work. Please like and subscribe. It really helps out the channel. Now let's get back to the video. So the next point is the Tesla strategy, right? We know that seasonally and market risk-wise, Tesla is a very dangerous stock. If the market drops, Tesla drops with a beta of 2, with a leverage of 2. So NASDAQ goes down 10%, Tesla goes down 20%, which would be $90. That's why we have to watch the market. If you are a big Tesla fan and say, oh, Tesla's not going to drop when the market drops, you're totally wrong. Tesla is absolutely going to drop with its beta, independent of whatever Tesla does, whatever the fundamentals are, because in these scenarios, the market just drags it down. It's a rapid correction. You have no chance. So we need to keep watching out. But as I said, I don't think the risk is very high in the next 2 to 3 weeks. Okay, the affordable model launch, we have covered this in the previous videos, very likely to happen. We see all these pictures coming out and, long story short, watch the video. But Tesla has prepared the launch of that affordable model that expands the TAM for a long time. They were ready to launch it, in my opinion, in July this year. The big, beautiful bill then, led to the expiration of the tax credit, which now leads in Q3 to a total boost of Tesla core sales of the Model Y and Model 3. That is why they're not launching it. And that makes it very likely that Tesla is fully prepared to launch that affordable model now, and they strategically postponed it because they wanted to harvest on the higher margin models this tax credit expiration boom, where people pull forward their consuming behavior of that more expensive Tesla Model Y into Q3, which ended yesterday. So let's take a quick look at the calendar and see what October has in stock for us. So here's the calendar, and I went through it in the last video, but I want to make it very quick to give you that overview. Again, here are the 3 scenarios that I'm seeing for the launch. I think there's a 90% chance that we launch in October. I think there are 3 scenarios when Tesla launches and announces the affordable model, which is the key catalyst here. Number 1, next week. That's the purple one. Number 2, they do it, but more professionally with an explicit launch event where people get invited and they present this new amazing affordable model. If that happens, most likely, that's a 65% chance. Number 2, the green one, that this happens on October 16th, Thursday in the middle of the month. And if that happens, if there's a dedicated event, not like the purple, where they just launch it nonchalant this or next week and say, boom, here it is. If the event happens October 16th, then the announcement will be probably Monday the 6th, the announcement that the event is coming, okay? Or there's a third scenario, very unlikely in my opinion, they launch it after the earnings call, which is October 22nd, here the blue, very big deal earnings call, and they launch it on the 30th or something, maybe on the 23rd, unlikely. And then they would have the announcement before the earnings call that this event is coming. Both the announcement and the actual event can be key catalysts. That is a little bit the playing field. That's what you have to play. Here is my conviction. This is going to happen for the model launch. And the tricky part is we have 2 risk events that we kind of want to avoid with trades like that because it introduces orthogonal risk. Number 1, tomorrow will be very likely the release of the delivery numbers of September and Q3 with that. They are very important. Now people are pretty bullish on it. I will go into this in a second, but it introduces risk that is outside and orthogonal, independent of our trade. We don't want that in a trade. I don't like it. Even though I'm pretty bullish, but these delivery numbers are like earnings. You can't really carve out alpha here because too many people know too much stuff, more than I do. And so I don't know how this is going to go. So here's a plus minus 5% move, maybe a little less, likely less, but that could tank the stock 5% or drive it up 5%. So we don't want that if we have our beautiful little scenario here. So I will go into this in a second. I actually take on the full risk now with deliveries because the stock moved too much today. So I jumped in early. I think we have to take the delivery risk. It's probably going to be fine. Even if it tanks 5%, I think they will make up for it. And I think it's more likely to be stable or a little up. But you don't know. I don't have any alpha in that red area. And then, of course, we have the earnings. And earnings are super speculative. Same rule. Do not hold any dangerous trades through earnings unless you know something, which is probably, you have to be cautious. That could be illegal, depending who you are and where you know it from. My take on earnings is I have no alpha. I have no edge on earnings. I just don't know more than all these Wall Streeters and insiders who know more about earnings. So you don't want to hold through that. But look, it coincides very nicely because the highest probability where the launch happens is in between these 2 risk elements. So in the middle 2 weeks of October, that's where we want to be full on in the trade. So what do we do now? I think the affordable model launch, depending how much it's priced in, depending how many people watch my videos, who are actually hedge fund managers and mutual fund managers. I know my videos leak all the way into Wall Street. That doesn't mean people react to it, but who knows, right? I think I'm making a very cogent point here that a lot of people will take over, that this affordable model launch will happen, and Wall Street knows it's a very big deal. I think the affordable model launch will likely get us to all-time highs. Just on a technical basis, the 480, 488 all-time high level, right, could drive us there, plus 40, plus 10%, not in a single day necessarily, but as a run-up into that event, for example, or run-up into earnings after the event. More likely than not, that's what we are looking at. And that is the alpha we want to capture, right? If we look at Tesla today, interestingly enough, Tesla's up 10 points today. I put on the trade that I will explain in a second, roughly at 450, or what was it for? When did I put it on? I can tell you the exact options prices in a second, but I'm sorry, I am a little late for you guys. So you missed out here that upside. I captured that already, but who cares? It's probably not that important. And now it's going down again. Let's see. If you get it under 450, it's going to be fine. But you see, there is a lot of activity here, even though when we look at the market, the market is actually down, in my opinion. Let's see what the latest is. No, Nasdaq is now up. Wow, what's happening? It was down. So that's very interesting. It's just jumping around. It's going up. The market is very bullish right now. No seasonal correction anywhere to see. So, but Tesla was even stronger. And so, yeah, Tesla pretty strong. So what do we do now? Let's jump back and do some thinking here. If we know we have the calendar fleshed out, this is going to happen, very high conviction, very nice alpha because the market didn't really price it in. What options do we actually have? Let's jump right into it. What options do we have to capture that, $20 to $40 move that we can now triangulate into somewhere around here, not with complete certainty, but if this happens, this run-up will happen between the 6th and the 22nd, which is a very good thing to know, right? If you can narrow down the window of something happening, you, of course, reduce your exposure risk to other risks like market corrections and things like that, and other events that can drive Tesla. So that's beautiful. That's why I'm so bullish on this trade. It's a very concentrated timeline. It's a very nice alpha thing. And I have very high conviction that they have to launch this affordable model and that they can. That's what we want to capture. So how do we do this? When I talk about the strategy here, it's important to outline for whom I'm doing this, right? It's for people who have high Tesla exposure, who have a strong core position of 100% of their portfolio in Tesla, or let's say 50%, or whatever big chunk you have that you're not touching, long-term Tesla investors like me, who want to add additional alpha exposure and tactically take advantage of this. So this is not for newbies who are not in Tesla. If I was a newbie and not in Tesla, I would just load up on Tesla and not do anything, right? This is for greedy people who have complete exposure, who are fully invested in Tesla, maybe even more than fully, but think, I don't want to miss that and just add to my performance. So what I'm planning on doing here is adding to my annual return 5 to 7%, which is a very huge deal. If you can add to your annual total portfolio return, not just Tesla, the total portfolio return, if you can add 5% in 2 weeks with a nice trade, you win, right? If you have a 50% return target per year, each of AGI, the new capital returns post AGI or during AGI should be 50%, in my opinion. That's my estimation. So anyone who tells you anything else, I think misunderstands this, the age we live in. I think this old rule of Wall Street, 10 to 20% annual returns, maybe 12%, is not true anymore. When you look at Tesla, NVDA, Palantir, Bitcoin, Ethereum, and so on and so forth, you should make 50% a year. And if you do this 10 times a year, you add 50%. So pretty good. You actually add more because it's compounding. Okay, what do we do now? Our tools to capture this upside in these next 3 weeks are 3 options. No pun intended. We have call options. You can buy calls. You can go margin, right? You can buy stocks on margin because I'm assuming you're fully invested. So you don't have any money left, but you could buy stocks on margin. Or you could do the riskiest of all and go short in the money puts, which is my favorite. Right? Spoiler alert, I'm doing short puts, but let's go through it systematically. Basically, when I make these decisions, what I'm going to do, I show you here the options chain, right? When you look at this, what's happening here? Where is in the money here? Well, let's go first back here and explain first the reasoning. How do you even compare these things? Let's just think about, normalize it around a $100,000 Tesla position. And let's say that's your entire net worth is $100,000 in Tesla. Right? If you have 1 million times 10, if you have 10 million times 100, if you have 10,000 divided by 10, doesn't matter. I normalize it on $100,000 and they're all in Tesla, right? If that is the case and you have a reasonable broker, you get $50,000 in margin, 50% of your position. You have free as margin, just as an estimate. And if you would buy Tesla stocks on margin, you get 50% of these again in margin. So that adds another 25,000. So basically you can buy $74,000 worth of Tesla shares if you go the margin route, right? If you want to have full leverage the hell out of your portfolio and go all in on margin, it gives you $74,000 additional dollars in buying Tesla shares. And that means you're basically leveraged by 1.74x. right? You are at 1x here. You have $100,000. You buy with $100,000 Tesla shares. Now you see this opportunity. You want to take some risk, and you're going all in and exploit the entire margin you have. You get 1.74x leverage. So if Tesla goes up 1%, you go up 1.74%. If Tesla goes up 10%, you go up 17.4%. Now, what I don't like about this is it's very limited leverage, right? That's not a lot for having such a high conviction trade. And at the same time, you have complete margin risk. If this goes into the wrong direction, if you fully leverage this out and Tesla even drops $10, you start getting squeezed out. Get a margin call. If it drops $20, which is like only 5%, that can happen in a day for no reason, you are getting squeezed pretty badly. And then you lose money. And then Tesla spikes up again, but you can't capture that upside because you got squeezed out. The whole sad story of margin and, going over leverage. So you get bad leverage and you have full margin risk. I'm not a fan. So what about, let's go to long calls. When you look at calls, right? You would say, well, calls are great. Let's do calls. Well, we have two types of calls you can look at. One type are leaps, long-term calls. Long-term calls have the advantage that you don't bleed premium like short-term calls. And what that means is if you look at very long calls, like for example, expiration, let's say a typical leap, January 15th, 2027, regardless what Tesla does now, in the meantime, you're not going to lose a lot of time value because it's so long out. You're not deteriorating. There's no theta burn or nothing of any significance for 3 weeks. So that's good news. But the bad news is, how much can you actually buy with your $50,000 in margin? Because calls give you zero additional margin, right? If you have $50,000 in margin from your 100,000 position and you want to spend it all on calls, you're getting no bonus here. You just spend your money in margin. And what do you get? Let's take a look what you get. Let's say you're buying, what do you want to buy? You want to buy a $400 call, right? $400 strike price, 2027. That costs you $149. That's a lot of money. That costs you $14,000. So for one contract, then you get $100 worth of shares. And at $100,000, let's say roughly you have 200 Tesla shares. That's your core portfolio. So here you're buying one contract for 15,000. So you can buy 3 contracts. So now you have basically 300 synthetic shares on top of your 200. As you remember right, instead of being leveraged 1.74x with margin, now you're leveraged a little bit more, right? You have 500 instead of 200, which means you're leveraged to 2.5x roughly. So now you're at 2.5x. Not bad, right? So you can do that. You can also go a little bit out of the money here, 500, and buy more of them. But then your delta is a little lower. So if Tesla actually moves, this thing doesn't move as much. And you're not really 2.5x leveraged because these things don't move as much as a stock would move. So it's not completely synthetically the same as having 300 shares if you have 3 options call contracts. So remember this. So it's not bad, pretty expensive. You can buy 3 call options with that, right? Now let's go into the fourth scenario. The fourth scenario. That's exactly what I did. Instead of going long calls, you can go short puts, and you can go short in the money puts. What does it mean? For example, you're selling the 460 strike, but now we have to go back, of course, because now you want to go very short term. Let's say October 17th, right? October 17th. Now we have to be a little tactical. We are still here. Okay. October 17th. You want to expire here, not after earnings, because this time you're on the other side of the trade. You want theta burn. You want to take all the time value out of these things and put it in your pocket. And so you want to not have an expiration date after earnings, because if that happens, you have all that premium that's not expiring. So you can't pocket it, and you do not want to hold these short puts through earnings. That's way too dangerous. So basically you have to bet on Friday the 17th as expiration, right? So let's look at the options chain. And let's see, did I do this here? Yes, we have October 17th expiration. And here are the puts on the right side. And if you look at, for example, Tesla is currently at 455. Let's just for fun take the 455 strike price. So this has no intrinsic value, this option, the put option. You understand, like this thing is worth nothing today intrinsically. but you get $21 for that thing if you sell it to someone else, right? If you would buy that put option, you have to pay $21 to protect yourself from a drop. $21 for nothing. So if Tesla would not move and you pay $21 to buy that put option and Tesla goes sideways until October 17th, you lose your entire $21. If you sell this put option, you can just sell these things, right? It's like shorting. You get $21 if Tesla stays here or goes up. And you know that you're very bullish that Tesla is going up. Of course, it can drop in between because of deliveries to 420 or something, but then it goes up 40, if I'm right, and you end up at 460 and you still pocket the entire $21, right? So this is very interesting because it gives you buffer to the downside. So even if for some reason we would be wrong and Tesla would actually go down from here to October 17th, you still make money even if it goes down, unless it goes down too much. Right? If it goes to 425 or 24, then you start losing money. But even if Tesla would drop to 430 from 455 and you get $21, you make money. Isn't that crazy? So that's the beauty of these things. So let's do the math. I mean, 440, right? Because the break-even point here is 455 minus $21, which is 434. So as long as Tesla doesn't drop below 434 by expiration, you make money. So that's very good. You can go more into the money. You get more money, of course, if you sell the 470, you get $30. Oops, what did I do here? You get $30. But, you know, that sounds good if it actually goes to 470, but you also lose buffer, a lot of buffer. You know, 470 minus 30, then you're talking about 440, where you start losing money. You can choose $21 and you have a buffer all the way to 430. I actually did a 460 and got $29 this morning, and now you get $24, so already made $5. Not bad at all. Times 100 per contract, so 500 per contract because it's 100 shares. If you have a lot of contracts, it adds up very quickly. So when you do the math on that, how much margin does that eat? Well, it depends, right? For example, if you buy a put on the other side to condense the margin requirement, I don't want to get too technical, but if you basically buy a put, let's say the 380, it costs you only $2, right? You buy the 380 and then you have to put up the differential in margin for 60, for 80. So you're talking about $8,000 per contract. So now you have a margin of $8,000 per contract. If you have 50,000 and divided by 8, boom, you can do the math. 50,000 divided by 8. Now I have to do math. That's like 5 is 40,000. So you're basically getting 6 contracts, 600 shares. And here, within that range, you're not just at a delta of 1, you're actually at a delta of more than 1, which is very fascinating because you're pocketing this entire differential of $24 at 460, even though the stock is at 455. So you get an enormous delta all the way up to, 24 plus all the way up to 485, you get enormous deltas because you make more than you would make with a stock. So here, now you go from 300 additional shares synthetically with long calls or long leaps into 6 and more. So you basically double what you're getting. I hope this is not too complicated, but you have to think like a greedy capitalist. If you do this, your max you can get with a short put in the money situation with $50,000 in margin is 600 shares. If you only have 200 right now with 100% of your portfolio, 200 shares, $100,000 in Tesla, if you go, long stocks on margin, you add 74,000 in shares. If you add long leap options, calls, you're adding 300 shares. If you go in the money short puts and cap them on the downside, you have twice as much leverage. So now you're going to 600 additional shares, to 800 total exposure, and even more technically. So you go from 200 to 800, which is, 4x leverage. So that's why I like this. Plus you get the buffer. The main risk, of course, doing any kind of short put is you have this huge leverage. And if Tesla goes down, you have a huge problem. So you have to be a little cautious. So I hope that was not too complicated, but play around, go to options chains and check out these options and you will understand what I mean. And just be very, very cautious because don't copy me. Don't try this at home. because leverage comes at a huge risk. Here's my disclaimer. I'm just sharing my trade. Don't do this at home. If you're interested in doing short puts and in the money puts, I would always recommend paper trading first, or start with one contract, which is the smallest you can get. Depending how many shares you have, one contract is 100 shares, and you will see what happens. And if you want to be more cautious, go out of the money, right? And see what happens. But be very, very cautious and understand the problem with short puts is you are fully exposed to the shares. And if they go down, you get murdered, which is dangerous. You have to be on top of it. But going short puts is one of the most magical experiences. Normally you go out of the money and get free money. In this case, because we are bullish on this move up, you can go into, but as I said, be cautious. Okay. Yeah. It's like explosives, right? You miss one time and it's very bad. You get wiped out. If you are wrong one time with, that much leverage on short puts, you have a huge problem. So when I'm doing this, I just do it to maximize and optimize my margin, the leverage on that. As I said, my objective here is to make 5% on my total return this year in this October trade on top of whatever I make. So it's pure alpha on top of my already alpha generating Tesla portfolio. Let's see how it goes. So I hope that was helpful, not too complicated, but I just wanted to share some thoughts on options. Let's see what happens. It's going to be very interesting. Let's conclude this video with a quick look at Tesla, up 2%, nearly $10. I got it somewhere around here, already made $5 on my short puts. Let's see how it goes. I'm only doing this because I have a high conviction that even if we see a drop on deliveries, which I don't think we will, but it could, this will be made up by the affordable model. And I do think we have a very high chance of hitting 480 in October. So I hope that was helpful and see you very soon.